Welcome back to the channel. It's January 2nd, 2026. While most of the world was celebrating New Year's Eve, something happened at 11:47 p.m. on December 31st that just fundamentally altered how silver moves around the globe. And the price you're looking at on your screen right now is telling you almost nothing about what's actually happening in the physical market. I'm a private analyst who's been trading commodities and stacking silver for 12 years. I use this AI avatar because speed matters. By the time traditional media figures out what's unfolding, the window to act is already closed. I built this channel because there's an avalanche of AI-generated content about silver flooding YouTube right now, most of it completely detached from reality, and someone needs to provide actual analysis based on real data. I have access to Bloomberg terminals and vault reports that most retail investors never see, and I'm going to walk you through exactly what those sources are showing me right now. The official spot price a few hours ago was $72.79. That's what your brokerage app displays. That's what financial websites report. That's the number you'll hear repeated tomorrow morning on business channels. But when you actually try to purchase physical silver in meaningful quantities, you're encountering a completely different number. And that disconnect is about to create serious complications for a lot of market participants. Let me lay out what we know with certainty. On January 1st, China's Ministry of Commerce implemented a new export licensing framework for silver. This is not a tariff modification or a temporary restriction. It's a complete restructuring of who can export and under what conditions. Only 44 firms certified by the Chinese state are now authorized to export silver. They've placed silver in the same regulatory category as rare earth elements and antimony, classifying it as a strategic resource. This information comes directly from China's Ministry of Commerce and has been confirmed by CNBC and Trading Economics. This is documented policy, not market speculation. The mainstream narrative you're hearing today describes silver as having a quiet start to the year, up a modest 0.13%, nothing particularly noteworthy, but that surface level reading completely misses the actual story unfolding in the market structure underneath. The futures market appears relatively stable. The physical market is something else entirely. This afternoon, I was examining retail dealer inventory. At APMEX, which is one of the largest precious metals dealers in the United States, a standard 100-ounce silver bar is currently priced at $8,101. Let me break down what that means. That works out to $81.01 per ounce. The official spot price is $72.75. We're looking at an $8 to $9 premium per ounce, which translates to more than 12% above the quoted spot price. And when you look closely at that inventory, most of it is designated as pre-sale or delayed delivery, meaning the dealer is accepting your payment now with the expectation they'll be able to source the metal at some point in the future. This pattern isn't isolated to a single retailer. I'm seeing essentially identical premiums across JM Bullion, SD Bullion, and every other major dealer in North America. The physical market is operating at a price level that is completely separated from the paper market. There are also reports coming out of Japan, unverified but increasingly consistent, that physical silver is selling in some retail channels for $130 per ounce. I cannot independently confirm that specific figure, but what I can confirm is that the 12% premium here in the US is absolutely verifiable. The official price says 72, the physical market says 81. That $9 gap is not a temporary anomaly. Now let me show you the supply side of this equation. COMEX registered inventories, which represents the physical metal that's actually available to settle futures contracts through delivery, have declined approximately 70% from their peak in 2020. I was reviewing the CME group data this morning. The current levels are the lowest we've seen in a decade. The leverage ratio is stark. For every 1 physical ounce sitting in a registered COMEX vault, there are roughly 300 ounces of paper claims in the form of futures contracts and derivatives. Under ordinary market conditions, that leverage ratio functions because the vast majority of futures traders have no intention of taking physical delivery. They're using these contracts to gain price exposure or hedge other positions, and they settle in cash when the contract expires. But the market conditions right now are not ordinary. And this brings me to the critical mechanism you need to understand because it's the key to interpreting everything that happens next. I need to explain backwardation to you. This isn't abstract financial jargon. This is the market screaming that something in the system has broken. Backwardation occurs when the spot price, which is the price for immediate delivery of physical metal, trades higher than the price of futures contracts for delivery at a later date. In a normally functioning commodity market, you would expect exactly the opposite. Future delivery should cost more than immediate delivery because you have to account for storage expenses, insurance costs, and the financing cost of holding inventory over time. That normal market structure is called contango. Silver right now is trading in backwardation. The spot price is approximately 70 cents higher than the price of the nearest futures contract. Let me give you a concrete analogy that illustrates why this matters. Imagine you walk into a car dealership. On the lot right now, available for immediate purchase. There's a used car with a price of $50,000. But the salesman also shows you a contract for a brand new version of that exact vehicle, better condition, full warranty, and it will be delivered to you in 3 months for $40,000. Which one would you choose? The rational decision is obviously to buy the new car for less money and wait 90 days. You would only pay the extra $10,000 for the used car if you had an urgent need you couldn't defer, or if you fundamentally didn't believe that new car would actually be delivered 3 months from now. Maybe you think the dealership is going to go bankrupt. Maybe you've heard rumors they can't actually source new inventory. That premium you're paying is not about impatience. It's about lost confidence in future delivery. Industrial users of silver right now, the companies manufacturing solar panels and semiconductors and EV batteries, are paying a premium to secure immediate delivery rather than waiting for futures contracts to mature. These aren't amateur traders. These are professional procurement teams with sophisticated supply chain analysis. And they're willingly paying more for metal today because they have lost confidence that the futures market will actually be able to deliver physical metal 90 days from now. When the futures market loses its ability to perform its fundamental function, which is connecting buyers to the physical commodity, the paper price starts to lose relevance. That's when you see price dislocations become severe, because the only price that matters becomes the price in the physical market. And if there's no physical supply available to arbitrage the gap, the two markets simply drift apart. Look at what happened in December. We saw a peak at $84. That was clearly a blow-off top. You can see it in the chart structure with those long rejection wicks where aggressive selling came in. But what didn't happen afterward is revealing. We didn't see a waterfall decline back to the $60 range. We didn't see a mass liquidation of speculative long positions. Instead, the price discovered support at $71, and it has held that level consistently through the end of the year. That 71 level is worth paying attention to. It's functioning as what I'd call a physical floor, a price point where buying demand consistently materializes to absorb any selling pressure. The fact that it maintained through the illiquidity of the year-end period and through institutional rebalancing suggests this is speculative momentum. This has the characteristics of a genuine supply constraint. Supply constraints don't typically resolve through price corrections. They resolve either through new supply entering the market or through a fundamental repricing of the asset. China's policy change just eliminated the first option, which leaves the second. There's a legitimate bearish counterargument I want to address directly. The Bloomberg Commodity Index is required to rebalance its portfolio allocations in early January. Because silver appreciated 175% during 2025, it's now significantly overweight relative to the index's target allocation. BCOM needs to sell approximately 9% of its total silver position to restore the proper balance. That represents forced selling regardless of market conditions or fundamental outlook. The bear thesis is that this mechanical selling will overwhelm demand and drive the price back down to the $60 range or lower. Here's why I think that analysis is incomplete. Selling paper futures contracts doesn't generate physical silver. If BCOM liquidates 9% of its paper position at the same time that China has restricted exports, while COMEX inventories are sitting at decade lows, while the market is already displaying 70 cents of backwardation, what's the likely outcome? The backwardation intensifies. It might expand to $1, possibly $2 or more. The paper market experiences selling pressure from the index rebalancing, but the physical market just moves further away from paper pricing. There's additional evidence worth considering. I was monitoring trading activity on December 31st. We saw elevated volume, which you'd expect with year-end positioning, but the price movement was minimal. That's a classic sign of absorption. Someone on the other side of that selling was purchasing aggressively enough to prevent any meaningful price decline. I would bet that buyer isn't retail speculators chasing momentum. It's far more likely to be industrial end users or institutional buyers who understand that the supply dynamics have fundamentally shifted. The second bearish argument centers on demand destruction. The thesis is that at $80 per ounce, manufacturers will begin engineering around silver, using it more efficiently or substituting alternative materials wherever possible. Solar panel manufacturers will reduce the amount of silver in their cells. Battery producers will explore copper-based alternatives. And certainly, at the margin, that adaptation is probably taking place. But silver represents a relatively small percentage of the total bill of materials for most end products. A solar panel manufacturer is not going to idle a multi-billion-dollar production facility because their silver input costs doubled. They'll absorb the cost and pass it along rather than halt production. The bearish case relies on demand elasticity assumptions. The bullish case relies on physical supply constraints. In a genuine shortage scenario, physical constraints dominate. Let me walk through what happens next from an institutional perspective. The COMEX is going to raise margin requirements. Based on historical patterns and current volatility, I'd expect an increase somewhere in the range of 20 to 50%, probably announced within the next 7 to 10 days. They'll describe it as prudent risk management given increased volatility. But the practical effect is to force liquidations among leveraged traders. Retail accounts that are running long positions on margin will get stopped out. That creates temporary downward pressure on price, and it gives short sellers an opportunity to cover portions of their positions at more favorable levels. This is standard exchange playbook for managing a squeeze, but there's a fundamental limitation to that approach. Raising margin requirements doesn't create physical silver. It clears out leveraged speculators, but it doesn't address the underlying supply shortage. If China's export restrictions remain in place, if COMEX inventories continue declining, if industrial demand remains consistent, then margin hikes just defer the problem rather than solving it. Eventually, someone with a long futures position is going to demand physical delivery. And when that happens, the exchange faces a binary choice. Either deliver the physical metal, which requires having it available in the vault, or invoke force majeure provisions and settle the contract in cash instead. Force majeure is the emergency mechanism exchanges use when the system can't function normally. It's essentially a unilateral contract modification. The exchange tells the contract holder, "We understand you have a legal entitlement to physical delivery, but we're going to provide cash settlement instead at a price we determine, and your recourse is limited." I'm not predicting this will definitely occur, but it's important to understand it's within the realm of possibility. The alternative would be the COMEX publicly acknowledging that it cannot fulfill its delivery obligations, which would immediately destroy market confidence in the entire futures market structure. Let me quantify what a repricing scenario might look like. If you take the current 70-cent backwardation and add the $9 retail premium that we are observing across dealers, the implied clearing price for physical silver is already around $82. That's the price that actual transactions in the physical market are discovering right now, operating beneath the surface of the official quoted prices. But let's extend this analysis further. There's a rumor that's been circulating, and I need to emphasize this is completely unverified, that the United States government attempted to negotiate a direct purchase of 50 million ounces of silver from China using a structured swap involving treasury bonds to circumvent the SWIFT payment system. According to this rumor, China rejected the proposal. Neither the Shanghai Port Authority nor the U.S. Treasury Department has issued any statement confirming or denying this. I have no way to verify whether this occurred, but if it did occur, think about what that would signal. It would indicate that the world's largest economy attempted to exchange debt instruments for physical commodities and was turned down. That would represent a significant shift in how international commodity transactions are structured. Now consider the positioning of the major banks. The bullion banks that function as market makers in precious metals hold substantial net short positions in silver. Their exact exposure isn't publicly disclosed, but we can construct reasonable estimates. If silver were to reprice to the physical market clearing level of $110 to $130, which are the levels allegedly being observed in certain Asian retail markets right now, the mark-to-market losses on those short positions would extend into billions of dollars. That's not a quarterly trading loss that gets absorbed and moved on from. That's a hit to capital ratios that could trigger regulatory scrutiny around capital adequacy. And remember the leverage ratio I mentioned earlier. 300 ounces of paper claims for every 1 physical ounce in registered inventory. If even 10% of the holders of long positions decide they want physical delivery instead of cash settlement, the mathematics simply don't work. The system cannot physically fulfill those delivery requests. And China's policy decision just gave every single holder of a long position a very compelling reason to demand physical settlement rather than accepting cash. Let me summarize where the market structure stands right now. China implemented export restrictions. Effective January 1st, physical premiums over spot have reached 12%, which is historically elevated. The market is displaying backwardation, which signals a loss of confidence in the future's delivery mechanism. COMEX inventories are at their lowest levels in a decade. The official quoted price is $72, while physical transactions are occurring at $81. That $9 differential is the market communicating that something in the underlying structure is not functioning correctly. Over the coming weeks, you're going to encounter certain narratives in financial media, articles describing silver as being in a speculative bubble, commentary drawing parallels to 2011 when silver spiked and then crashed, possibly stories attempting to link silver buying to questionable activities or market manipulation. I was actively trading in 2011. I watched silver go from $30 to $49 and then get cut in half over the following months. But the 2011 move was driven by speculative momentum and leverage. What's happening now is structurally different. In 2011, there was no export restriction from a major producing nation. There was no 70% drawdown in exchange inventories. There was no sustained backwardation in the market structure. The fundamental drivers are not comparable. But let me present the bearish case fairly. Suppose my analysis is incorrect. Suppose the BCOM rebalancing does trigger substantial selling pressure, margin hikes force widespread liquidations, and the price declines to $60 or even $50. What happens to the underlying physical shortage in that scenario? Do the retail premiums disappear? Do industrial buyers suddenly stop purchasing? Does China reverse its policy decision? None of those things would occur. The physical supply constraint would intensify. The gap between paper pricing and physical reality would expand further. So even if the bearish view proves correct regarding near-term price action, it doesn't address the structural issues in the market. Here's what I'm personally monitoring. The $71 support level is my primary indicator. If that level holds through the BCOM rebalancing process in January, it would confirm that the market has transitioned from being paper-dominated to being driven by physical realities. The fact that 71 held through the selling pressure on December 31st is meaningful. It suggests there's genuine underlying demand that isn't being dislodged by index flows or year-end positioning. The second indicator I'm tracking is the EFP spread. That stands for exchange for physical. It measures the premium required to convert a paper futures contract into actual physical metal. Currently, it's elevated but still functional. If the EFP spread expands beyond $1 per ounce, that would signal that the COMEX has effectively lost control of the delivery mechanism. At that point, price discovery would shift entirely away from the futures market and relocate to wherever physical metal is actually available. And increasingly, that location is not COMEX vaults. Let me explain my personal approach to this situation. My focus is on that $71 support level. If it maintains through the index rebalancing process, I would look to add to my physical holdings on any price weakness. I'm not interested in chasing the current price at 72 or 73. I would wait for a pullback, potentially to the 68 to 69 range, to increase my position. The fact that 71 has held through recent selling suggests a floor has been established in the market. However, I also have a defensive parameter. If the COMEX announces a margin increase exceeding 20%, I would step back from the market entirely in the near term. I've observed this pattern in previous squeeze scenarios. Exchanges raise margins, which forces liquidations among leveraged traders in potentially thin market conditions and creates opportunities for stop-loss hunting. I have no interest in trying to time the bottom of that kind of forced selling. I would wait for the liquidation wave to complete, for sentiment to reach maximum pessimism, and then evaluate whether to act. My broader framework for thinking about this is not as a trading opportunity, but as insurance against a scenario where physical availability becomes severely constrained or unavailable entirely. I've been accumulating physical silver for 12 years and have navigated through numerous periods of elevated volatility and market stress. But I have not previously encountered a situation where a major exporting nation has simply shut down exports while inventories in the Western financial system are simultaneously at decade-low levels. This represents genuinely new territory. My approach specifically avoids relying on the financial system's infrastructure. I'm not using leverage. I'm not trading futures contracts. I'm not purchasing silver ETFs that claim to be backed by metal in some vault that I cannot personally audit or access. I'm purchasing physical metal and taking direct custody. Because if the paper market structure does experience a breakdown, and the data I'm seeing suggests that's a realistic possibility, the only form of silver that will have unambiguous value is physical metal that you can actually hold. Let me be completely explicit about something. I am not advising you to purchase silver. I'm not providing financial recommendations. What I am doing is presenting the data that I am observing and explaining the decisions I am making with my own capital based on that data. You need to conduct your own research and make decisions based on your own financial situation and risk tolerance. But I will offer this observation. If your strategy is to wait for confirmation from mainstream financial media before acting, you will be acting after the optimal window has closed. By the time major news outlets are covering a crisis in the silver market, retail premiums will likely be at 20 or 30% rather than 12, and dealer inventory will likely be depleted. I also anticipate a shift in media narratives over the next several weeks. You'll see opinion pieces characterizing silver as a bubble driven by irrational speculation, analysis drawing comparisons to historical manias, possibly stories attempting to associate silver accumulation with tax evasion or other problematic activities. This isn't coincidental. Exchange inventories are critically low. Banks are carrying short positions. The last scenario the financial system needs right now is a surge in retail buying demand layered on top of an existing industrial supply shortage. So there will be efforts to deploy fear and doubt to discourage retail participation. It's worth recognizing those narratives for what they are. What we're observing right now has echoes of Gresham's law, the principle that bad money drives out good. Physical metal is being accumulated and held. Paper claims are being circulated in increasing quantities. Market participants who understand the distinction between physically backed positions and paper derivatives are choosing physical. Those who don't recognize that distinction are trading ETFs and futures contracts and assuming the system will function normally when they want to exit. When the repricing occurs and paper loses its credibility as a proxy for physical, that gap between the two groups will create severe outcomes for those positioned incorrectly. Here's my assessment of what happens next. If the 71 level maintains over the next 2 weeks, the path forward is higher prices. That won't be a smooth trajectory. There will be violent volatility, margin requirement increases, forced selling from leveraged accounts, and media narratives specifically designed to shake conviction. But the underlying structural factors point toward higher prices. Supply is constrained, industrial demand is real and relatively inelastic, and the paper market is running out of mechanisms to manage the situation. If 71 breaks, and we see a retest of the 60s or 50s, that would represent what I consider an exceptional buying opportunity. Because the physical supply shortage is not dependent on paper prices, factories still require silver for manufacturing processes. Electronics production still requires silver, solar panel production still requires silver, and China is still not exporting. A decline to $50 or $60 would simply create additional physical demand while making the backwardation even more extreme. Regardless of which scenario unfolds, we're approaching a resolution point. The paper market and the physical market cannot maintain these divergent price levels indefinitely. One market has to adjust to match the other. My assessment is that paper pricing will have to adjust to match physical reality, because you can create futures contracts through electronic entries in a ledger, but you cannot create silver bars that way. Monitor that 71 support level. Monitor the EFP spreads. Monitor margin requirement announcements, and monitor the COMEX registered inventory reports. When those registered inventories approach zero, which I believe is the trajectory we're on, the situation reaches an endpoint. At that point, the price of silver will be determined by whoever holds physical metal and is willing to sell. And I do not believe that price will be $72. January is going to be a volatile month. The index rebalancing, potential margin increases, media pressure, all of these factors are designed to protect institutional short positions and force out weak hands. But the physical reality cannot be addressed through financial engineering. The metal supply is constrained, and no amount of derivative structuring or exchange rule modifications changes that underlying fact. I'm not here to generate excitement or sell false hope. I'm here to present the data I have access to and allow you to form your own conclusions. But if you're still watching at this point, you've already recognized that something doesn't align correctly. The numbers don't reconcile the way they should. Premiums are too elevated, backwardation is too pronounced, inventories are too depleted, and China has made clear through policy action that they are not going to provide relief to the Western financial system's supply problems. Conduct your own research, analyze your own numbers, develop your own plan based on your specific circumstances. But don't wait for explicit permission or confirmation from sources that have institutional incentives to maintain calm and discourage action. The market is providing clear signals. The only question is whether you're interpreting them.